Hi there, welcome to a revision topic video looking this time at shifts in aggregate supply. It's part of our study of the economic cycle. So let's look at one example to start with. In this diagram, there's been an outward shift in aggregate supply. Approximate causes could include, for example, increased productivity, together with a fall in the price of essential raw materials and components used by lots of different industries. That causes the short run aggregate supply curve to shift outwards, and that causes you to move down the aggregate demand curve. So you see an expansion down the AD curve to a new equilibrium. The price level has gone down. The real national output has increased to Y2. And crucially, I think the key thing there is to link that fall in costs, for example, with an increase in business profitability. Our second diagram shows an inward shift of aggregate supply, and again, approximate cause could be an increase in unit labour costs, or it could be a general increase in the world price of commodities for a country that's a net importer. So if the aggregate supply curve shifts to the left, assuming no change in the AD curve, we will see a higher price level, GPL2, and that's known of course as cost push inflation, and also a lower level of real national output, Y2 instead of Y1. The relative effects on output and on inflation, of course, depend on the elasticity of the aggregate demand curve. Now, I just want to send a few comments down your way about whether a supply curve can actually shift to the left in the long run. This is quite interesting. The normal assumption is, of course, that PPFs for countries shift outwards, that countries grow, and that over time a nation's productive capacity will increase. And that's true for most countries. After all, most countries grow over time. There are circumstances, however, where the long-run aggregate supply curve can shift to the left. There can be a reduction in a country's potential national output. And here are just a few of these potential causes. One has to think about, for some nations in particular, the dreadful damaging effects of natural disasters, some of which are linked to climate change, extreme weather events such as drought and floods, a tsunami, the impact of earthquakes on a country's productive capacity. Those can certainly cause a fall in productive potential that takes many years to recover. When we think about geopolitics, the devastating effects of sustained civil war and other forms of political conflict, they can have generational effects on a country's productive capacity. It may be the case, for example, if you're studying labour migration, that a country is depopulating, that there's a large-scale net outward migration of skilled workers, be they workers in construction or medicine or finance, who knows. So the brain drain of workers could, in theory, if it's sufficiently big, cause an inward shift of aggregate supply. And you can also sometimes get a kind of productivity decline. Perhaps a country isn't investing enough even to replace technologically obsolete and worn out machinery. So if a country has a particularly low level of net investment, in fact if net investment is negative, the capital stock could actually shrink and the LRS curve could shift to the left. So I think the key takeaway point from this slide is that the aggregate supply curve in the long run doesn't necessarily always have to shift out. It can shift to the left. What about the macroeconomic consequences of a fall in aggregate supply? So AS can fall in both the short term and, as we've just explained, in the long run. Here's just a nice way of building more explanation into your analysis. I've put down here 4 possible causes. There are many, but here are 4 causes of a fall in AS. And it's just good in exams to just develop your point and explain what a possible consequence could be. And obviously you can evaluate it a bit later. Let's take, for example, a brain drain, significant outward migration of skilled workers. In theory, it could actually cause inflation because the country's supply side potential has fallen for a given level of demand. There's a big fall in capital investment spending. Then investment's an important component of demand, but it's also an important supply side variable. So less investment is going to hold back economic growth. My third example is increased production costs from commodity prices, oil, gas, copper, what have you. Well, that could feed through to lower profits for airlines, for transport companies, for manufacturers. And if profits fall, there could be a knock-on effect in terms of investment and employment. In other words, a negative multiplier effect could kick in. And significant major political dislocations, significant natural disasters, earthquakes and floods and things can have a very damaging effect on a country's trade balance, particularly if these natural disasters affect their major export sectors. So this macroeconomics, it's a sort of jigsaw that eventually comes together. But if you think about some of the causes of AS, they can have significant, important macro consequences for the ability of a government or a country to meet its chosen macroeconomic objectives. So there we go. We've just spent a few minutes looking at shifts in aggregate supply, both in the short term and also considering some possible long-run consequences. Hopefully that's been useful for you, and catch you again sometime soon.